Hi, everybody, and welcome to today's live webinar session on Saudi Arabia's tax and accounting requirements. My name is Bianca Beck, and I am Sovereign PPG's Middle East Marketing Manager. Before we get started, I just wanted to let you know about a couple of house rules. The session today is being recorded, which means that we'll be able to share this with you along with our presentation deck when we conclude. And please do feel free to ask any questions in the Q&A section, and myself and Mehdi will be able to address them for you at the end. Our presenter today is Mohammed Ali Mehdi, who is our Senior Finance Manager in the Middle East, who's particularly focused on our Saudi internal and client accounts. So let's get started. Mehdi, over to you.
Thank you so much, Bianca, and a big thanks to everyone for joining this webinar. So just to get things started, I'm going to discuss the common challenges faced by most of the entities operating in KSA, and then I will try to focus on the same areas in this webinar so that it can be helpful for you to tackle these challenges. So the first thing is Arabic language. In KSA, maintaining accounting records and preparing financial statements in Arabic is mandatory. However, many companies use the accounting softwares or the ERPs, which can produce the reports only in English, which makes compliance quite challenging. The next is e-invoicing. E-invoicing is mandatory, and many companies find it difficult to ensure invoices follow the correct templates and their systems are properly integrated with Zakat when it is needed. Um, Moving on to transfer pricing compliance, this continues to be growing area of focus for Zakat. Companies make sure they must have to make sure that all the related party transactions are at arm's length principle, proper documentation and disclosures are in place, and missing this can easily trigger reviews or fines. Next is frequent ZK updates, frequent updates, and our changing VAT, CIT transfer pricing rules can be really tough for the finance teams. Zakat versus corporate tax classification. In Saudi, some companies are subject to Zakat, some companies are subject to corporate tax. But in case of common ownership, companies may be subject to Zakat and corporate tax at the same time, so it can be trickier for many companies. Taxation, many companies struggle with no-resident tax, withholding tax, reverse charge VAT, and meeting filing deadlines. Even minor delays or errors can result in hefty penalties. These are the common challenges faced by most of the companies. So what will be covered in this webinar? I will try to focus on the essential knowledge of accounting and bookkeeping requirements in KSA, corporate tax and Zakat obligations for different business structures, understanding of VAT and WHT in KSA, e-invoicing and digital compliance, and requirements for the audit requirements for the companies in KSA. It is important to know these things because the failure to comply can lead to fines and suspension of even the commercial licenses. And it is essential to maintain good financial and regulatory standing. So, yeah, starting with accounting and bookkeeping. KSA has adopted IFRS, International Financial Reporting Standards. They didn't try to reinvent something. They're using the same IFRS which many other countries are using. But they have made some amendments, some for adoption to align them with the local laws. The body which is governing this is Saudi Organization for Chartered and Professional Accountants. So they enforces and sets accounting and auditing standards applicable to entities in KSA. Language, as I mentioned, in challenges is used for all the communications with government bodies, and for presentation of financial statements is Arabic, and the currency used is Saudi Riyal. Retention period for accounting records is 10 years. All the supporting documents, accounting records, invoicing, everything you have to retain for 10 years. Yeah. So moving on to financial year end, many companies who are just moving to KSA or in their first financial year end, they are confused like what year end they can pick, can they align with the holding company or not. So default year end is 31st December. The financial statements are prepared annually based on the chosen financial year. Zakat tax returns must align with the same year end. Um, in case of branches can follow the parent company year end, or they can use the local Saudi year end. So the option is available. But it must be consistent across VAT, corporate tax, and Zakat reporting. Um, so first financial year end, it can be a short period or it can be long period, depending when the company is incorporated and what suits you. You can opt accordingly. For instance, if a company is incorporated in July this year, so they can go for a shorter period, which can be ending on 31st December 2025, or they can go for a longer period, which can be 31st December 2026 next year. So the maximum time for first financial year end is 18 months. So you can choose your financial year end accordingly, but for that you have to follow a process and do some documentation, get the regulatory approvals. Only then you can change your financial year end. Yeah. One more thing, if you want to go for a financial year end other than 31st December, there should be some rationale behind it. For instance, if you want to align your financial year end with the holding company, in that case, you can go for a different financial year end, or whatever will be your basis of decision, you need to share with the regulatory authorities. And if they find it logical, only then you are allowed to change your financial year. Uh, Audit requirement in KSA, it is mandatory for most of the companies, for all LLCs, joint stock companies, foreign-owned entities, MISA licensed entities. It is mandatory for them to get audited financial statements. Audit must be conducted by auditors licensed by SOCPA, which means that if your company is based in KSA, you cannot get it audited by any auditors outside KSA unless they are licensed by SOCPA. Only licensed auditors can conduct the audit. Then you need to submit financial statements within 6 months after the end of financial year. Financial statements are submitted. They have unique system of portals. Portals are used for most of the things there. So financial statements are uploaded on Quime portal, and you need to retain your audit reports for at least period of 10 years. Auditing standards, same like IFRS. For auditing, they are using international standards for auditing, but as adopted by SOCPA. So they have made little modifications for adoption. Oversight and compliance. SOCPA oversees auditors' quality and licensing, and ZATCA at the same time. They may ask for audited reports. You're not supposed to submit, but if it's requested, then you have to submit with ZATCA as well. Keynotes here. Um, Auditor's appointment, it is done by the shareholders of the company. It should be properly documented. Failure to submit audited accounts may lead to penalties or even suspension of your CR. Yeah. In terms of timeline, once your financial year ends, for instance, if your financial year end is 31st December, you should be able to finalize your financial statements maximum within 3 to 4 months after the end of financial year, because your tax filing deadline comes before the deadline for audits. So for audits, you have period of 6 months, but for tax, it's 4 months. So you have to finalize the numbers, because if you have to change the numbers once the audit is done, that can result in fines and penalties as well, because the tax assessment may not be correct in that case. So period for filing of financial statements is 6 months. So next thing is e-invoicing. So it is evolving. Different changes are being introduced. Updates keep coming frequently in this regard. Currently, there are two phases, phase one and phase two. Phase one is it is mandatory for almost all VAT registered businesses. They should be generating e-invoices, electronically generated invoices, and sharing with the customers. Physical invoices are not acceptable. Those invoices should meet certain specifications and they should have QR codes. QR code must encode key invoice details, which are they should be able to show the seller's name, VAT registration number of the seller, invoice total, VAT total, and invoice number, which should be unique. Cryptographic stamps are needed, but only in the phase two. Phase two is when you are supposed to integrate your e-invoicing system with Zatka. In that case, there are further steps needs to be taken when it is required, depending on the size of the company and the transactions. Zatka notifies to the companies, and then they have to take the required steps to ensure this integration, which is quite challenging for someone who has not operated in KSA and they're moving there or doing this integration first time, so they can find it quite challenging. Retention period is 10 years, and invoices must be available for Zatka inspection. They should be readily available whenever they are requested. Moving on to tax. Uh, According to income tax law, it is applicable to non-residents who are carrying on any activities in business-related activities in KSA, either through permanent establishment or without permanent establishment. It is applicable to them. And a resident person who is not a GCC or Saudi national, if carries on any activities in Saudi, it is also applicable to that resident. A person engaged in oil and other hydrocarbon production and a person engaged in natural gas investment fields is also subject to tax in Saudi. In case of companies, it is we have three different scenarios. One is a company which is owned by a Saudi national. In that case, that person is subject to Zakat assessment, this which is Islamic way of taxation. And if a company is owned by foreign nationals, in that case, the company will be subject to corporate tax, which is 20% tax rate applicable, no allowance or minimum threshold for that. So it is applicable to all such companies. There can be a situation where a company is owned by foreign nationals and partially owned by GCC or Saudi nationals. So in case of mixed ownership, both will be applicable, zakat and tax. The part of the profit which is attributable to those who are Saudi nationals or GCC nationals, zakat will be applicable, and the part which pertains to non-GCC nationals, that will be subject to corporate tax. Deadlines for filing of corporate tax, it is 120 days after the end of financial year. Applicable rate, as mentioned earlier, is 20%. So for instance, if you have this standard year end from January to December, in that case, the deadline for filing will be 30th April. If you have different year end, for instance, if it is from July to June, in that case, it will be 30th October. So it is 120 days after the end of financial year. One thing I would like to reiterate, so audit deadline is different. It is 180 days. Tax deadline is 120 days. So it compels you to finalize your financial statements and figures within 120 days after the end of financial year end. In terms of tax relief, in UAE, we have multiple free zones where you can enjoy some tax reliefs. But in KSA, we have just a few special economic zones. Integrated logistic bonded zone is one of them, and the tax relief period is 50 years. For this special economic zone, applicable rate is 0%. So for 50 years, you will be subject to 0% tax, and it can end if you ceases to qualify as an ILBZ entity. When 0% tax is applicable, it doesn't mean that you should not be getting registered for tax or you should not be submitting the tax return. Still, you have to get registered, you have to submit the return, but the only difference is that the rate applicable will not be standard rate, it will be 0%. If you are operating in ILBZ and you have income which is not considered as a qualifying income, that other income will be subject to standard tax. So in that case, in your return, you have to differentiate qualifying and other income, and then you will be taxed accordingly. From international treaty, a consideration, ILBZ is treated as a part of KSA, and in terms of withholding tax, dividends, royalties, technical and other services. If you make any payments cross borders, they are exempt from withholding tax. Other basic things about tax in KSA, deductible and non-deductible expenses. Any expense related to generation of taxable income is deductible. Depreciation on the asset is also deductible, but it should be calculated as per the tax rules, and it will be definitely different from your accounting depreciation in that case. Startup expenses, well, it depends, like how have you accounted these expenses in your accounting books. There are different ways as per IFRS. You can capitalize it and amortize it over 5 years, or you can expense it out in the first year. So depending on your accounting treatment, they will be deductible for tax purpose as well. Bad debts are deductible if they meet certain criteria as per the tax rules. So all of these expenses which you are going to claim as deductible expenses in your tax returns, they should be supported by verifiable documents. They can be substantiated by qualifying evidence. Only then you can claim them. Non-deductible expenses, any non-business expenses, tax, fines, penalties, or bribery related payments, payments to the shareholders or their family members, or the charitable contributions to organizations not licensed by KSA. All of these expenses are not deductible in KSA. So if you have incorporated a branch and you are based outside KSA, so that foreign company branch will also be subject to standard tax rate, which is 20%. Requirements related to audit and other regulatory and compliance related requirements, they remain almost same. The only thing you need to consider is that some expenses related to headquarters, they may not be deductible in case of branch in Saudi. Moving on to advanced tax payments. If your tax liability in a year, if it crosses a certain threshold, then you will be subject to advanced tax. Um, it is to clear or settle some expected annual tax liability during the year. It is only applicable to companies who are subject to corporate tax. It is not applicable to the companies who are subject to Zakat. So it needs to be done in 3 equal installments, which are done after your financial year end. It should be 25% of your previous tax liability, and you need to make payments in third, sixth, and 9 months at the time of and after the end of financial year. Based on your final assessment, all the adjustments can be made in case if you have over or underpaid in terms of tax, advanced tax. Um, uh, in case if if you don't make payments and were supposed to make payments, you will be subject to some fines and interest on your liability. Next big area of concern in Saudi is VAT. Uh, VAT it's higher as compared to UAE. You can say it's 15% VAT there. In terms of registration for the companies, threshold is almost same. It's $100,000 or 375,000 per year for businesses when it becomes mandatory to get registered for VAT. In case if your annual turnover is $50,000 or 187,500 SR, in that case you can voluntarily get registered for VAT. So all the registrations are done through portals. Submission of VAT returns is also done by the same portal called the Zakat portal. In case if you are having multiple branches in KSA, you can use single VAT registration number for all the invoicing. So each invoice should show your VAT registration number. Whether you are going to file VAT returns on a monthly or quarterly basis, frequency depends on your on the annual turnover. For some companies who reach a threshold which is defined for monthly filing, they have to file the monthly tax returns in that case. Tax return should show minimum input, output VAT, and VAT payable or refundable. Input VAT recovery claims, VAT on eligible purchases with a valid invoices can be claimed as input VAT. Partial recovery if expenses are mixed, if it is for business and personal. So in that case, you have to distinguish which part pertains to personal expenses that is not claimable for input VAT. Um, Record keeping retention period for VAT invoices is 10 years. And it is critical that you maintain this record, and it should be readily available because Zatka audits are quite common there. Late registration, late filing, or the late payments can result in fines and interest, and persistent non-compliance can even trigger the audit. So you need to stay timely, accurate, and well documented to avoid these fines. Non-resident VAT registration. So if you are not having any permanent establishment in KSA, but you are doing B2C transactions, in that case, it is mandatory for you to get registered for VAT. It applies, as I mentioned, if you don't have any physical presence in KSA. In case if you are doing B2B transaction, in that case, VAT liability shifts to so the recipient under the reverse charge mechanism. The process for registration, you need to get registered through the portal. Uh, you need to charge VAT on all the supplies made to KSA. Your invoices should be compliant as per the regulations. Retention period for record is same as it's for resident VAT taxpayers. And in case of non-compliance, you will also be subject to fine, interest, and potential audits. Yeah. So next major topic you can say is withholding tax in Saudi. It is applicable to almost all cross-border payments. So if you are based or if you have any permanent establishment in KSA, and if you are paying dividends, royalties, or if you have outsourced any services from outside KSA, any payments made in this regard will be subject to withholding tax. So withholding tax, you are supposed to be an agent of the government where you are will be deducting this tax from the invoice and then making payment to the government. So the crucial part is the deadline, which is quite strict and short. It is 10 days after the end of the month in which you make any payments which are subject to withholding tax. So, for instance, if you are making payments today on 15th of October, then you need to file the return and pay the withholding tax before 10th of November next month. And even if you make payments on end of this month, for instance, maybe 30th of this month, still the deadline will remain same. So effectively, you will have 10 days after the end of after the end of the relevant month to file the return and make the payment. Withholding tax rates are broadly a 5%, 15 or 20%, depending on the nature of transactions. Management fees are subject to 20%, royalties 15%. Any technical or consulting service related payments are subject to 5%. In the law, they have defined what kind of services are considered as technical and consulting services. Any other payments which are not covered by these three categories, they fall as in category of other payments. In that case, you will be subject to 15% withholding tax. So it's not only you have to file the return before 10th, you need to make the payment as well. If the return is filed but the payment is not made, still you will be subject to fines and interest in that case. Yeah. Double tax treaty. Withholding tax can be avoided to some extent if the transactions are with the country with which KSA has a double tax treaty. So to do that, there are two ways. One is reduced rate at source, and other is pay and refund approach. So reduced rate at source requires different procedure, as a document needs to be attested by the recipient country and then by KSA, and then after approval of ZATCA, you can be subject to reduced rate where a lower rate will be applicable to you, or it can be even 0% if any payments you are getting from KSA. In case of pay and refund approach, your full amount will be deducted against your invoice, which will be paid by the company and then company based in KSA. But you can get the refund. It requires different documentation, this approach. I mean, the option is available, depends what suits you most. You can just opt that. Um, in terms of documentation, you need to have contracts, invoices, payment records, residency certificate, withholding certificates. As mentioned earlier, late remittance or under withholding can result in penalties or interest, and that may assess even the additional tax. The best way to do that is you need to make certain changes in your accounting softwares, that they should be able to identify such transactions which are subject to withholding tax. You need to review classifications, ensure the correct rates are applicable, tax is deducted, so the information is readily available at the end of the month for filing, because the deadline is very tight in that case. So yeah. Next one is transfer pricing. Uh, Transfer pricing rules apply to related party transactions, persons under common control, both within Saudi or cross-border. So all the transactions with the related party should be at arm's length principle. Uh, and then these TP requirements have been now, I mean, it's continuously changing. We are getting updates on regular basis. So new laws are being introduced. Initially, it was only applicable to taxpayers. Now it has been extended to Zakat payers as well. So they are subject to transfer pricing regulations, but the thresholds for taxpayer and the Zakat payer is different. Um, uh, Other than that, at time of filing of your tax returns, if you are having any related party transactions, you need to make and submit certain forms with your tax return. One of them is control transaction disclosure form, and you are also supposed to file a affidavit which is required from a licensed auditor, certifying that TP policy was consistently applied and your transactions are at arm's length. Um, Requirements to prepare master file and local file, depending on the threshold of transactions with the related parties, is different for taxpayer. And Zakat payer, for taxpayer, it is 1.6 million USD, which is 6 million SR. And for Zakat taxpayers, the threshold is higher, which is 48 million as of now. From practical viewpoint and to ensure compliance, you need to ensure that your TP policies are updated. It is essential for especially organizations which are large and complex and they have multiple related party transactions. So they need to ensure that policies are updated all the time. They need to maintain benchmarks, comparable functional and risk analysis. One thing which can be done is advanced pricing agreements, APA. Use APA to secure certainty, because you get approval from the regulator, and you have more certainty and less exposure in that case. So non-compliance, in case of non-compliance, you may be asked to adjust the profits, reallocate expenses, and maybe the penalties can be imposed and can be assessed for additional tax or zakat. Um, the local file requirements I have explained already for taxpayer and zakat pays. So we can move to payroll now. Payroll, they are using WPS. All salaries must be processed through either Modad or WPS via Saudi Bank. So all the banks cannot be, the system which they are using is Modad, it's called Modad for payroll processing, but all the banks cannot be linked with Modad. Certain banks can be linked, certain banks cannot be linked. So if the bank can be linked with Modad, the payroll can be processed through it. If it cannot be, then every bank, they have their own templates which you need to follow to submit the payroll, and then it will be processed by that bank. But the bank should be Saudi bank. It cannot be done through foreign banks. Um, s- so if it is done through any other bank which cannot be linked with Modad, it adds another layer that for compliance, you still have to update WPS files on Modad system so that they have the visibility that you are complying with the regulations and paying salaries on time. In terms of the time for payroll, now the new regulations have been introduced in July 2024. It is mandatory for all the labor contracts. They have the standard Kiva contracts where you need to mention the payment date, and if you don't comply with that, the employees, they have option to file complaints against the company. Um, GOSI is social insurance. It is applicable in KSA. The rates are different for local employees and for non-Saudi employees. For Saudi employees, there's a range now and previously it was fixed, but now for new employees who haven't worked before, the rates are different for different years depending when they are joining the company. So it can be between 9.75% to 11.75%. For non-Saudi, it's only occupational hazard insurance you have to do, that is 2%. Employee contribution is also in range of 9.75% to 11.75%. Again, it depends when the employee is joining the company, have that person been employed before or not. So different rates will be applicable accordingly. End of service benefit, it is calculated depending on the contract type. If it is limited or unlimited, it must be accrued on monthly basis as part of financial reporting. Deductions and compliance, deductions must follow Saudi labor law. You cannot randomly deduct any amount from the employees' salaries. WPS must be uploaded on Modad on monthly basis. Payroll records should be retained for at least 5 years. Non-compliance may result in labor penalties and audit flags. Um, I have tried to mention few fines and penalties here. So in case of register failure to registration for VAT, it is SR 10,000. Issuing invoices, VAT tax invoices when you are not VAT registered, it can be up to 100,000. Not maintaining proper books, 50,000. Late filing and payment delays in VAT. In case of late filing, it is 5% to 20% of that due amount. In case of late payment, it is 5% per month of the due amount. E-invoicing failure can also result in certain fines, which can be up to 40,000. TP rules fines are highest in that case, and it can be up to 400,000. Uh, yeah. So the common mistakes which we see in KSA for the companies operating there, a failure to maintain Arabic records when ZATCA asks for certain information, or any regulatory body asks them for certain information. They have only records in English, even the financial statements in English, so that should be in Arabic, and only Arabic financial statements are acceptable. Ignoring related party transactions, transfer pricing you have seen, if you are non-compliant, can result in hefty fines, even up to 400,000. Late filings, there are filings related to corporate income tax, Zakat, VAT returns, WHT, VAT. So too many filings to do. So any late filing can result in fines, or if the errors are made, it can also result in penalties. Withholding tax deductions, at times it is confusing for the companies to classify transactions properly, like in which category they will fall. Is it technical service, or is it any other payment? The rate will change accordingly. So if any errors are made there, that can result in fines. And then another challenge mostly companies face is integration of their e-invoicing system with ZATCA. Yeah, that brings us to the end. Yeah. So now we can take some questions.
Thank you so much, Mehdi. We don't seem to have too many questions yet, but please feel free to ask. Abdul's just asking if the slide deck and presentation will be sent, and yes, it will. I'll send it after we conclude the session. Yasmin was just asking us to explain what is Zatka.
ZATCA is Zakat and Tax Customs Regulatory Authority. It regulates the whole taxation system in Saudi.
Great, thank you. And then the only other question I've got so far is from Tatiana, who's asking, is e-invoicing related only to AR or for AP as well?
AP is that's obviously the obligation of the company who's issuing the invoice. I mean, you are liable only for the invoicing which you will be doing. So in that case, AR is your responsibility. If someone is non-compliant, that's their responsibility.
Okay, and then a question from Lorna just came through about language. They're an international company and all of the books are in English. We are upgrading to Sage Intact, which is internationally recognized, but the language is an issue. So I'm assuming she's saying, with the Arabic requirements.
Yeah, I mean, um, the financial statements, audited financial statements, which are uploaded on Quime portal, they should be in Arabic. The financial statements which are attached to your tax return, they should be in Arabic. Then any accounting record which is requested by Zatka, which is the tax regulatory authority there. If they ask for anything, that needs to be in Arabic. In that case, obviously, there's no other way. You have to maintain your the financial record and the financial statements in Arabic.
I think she's saying that the auditors do issue financials in Arabic and English. So, Lorna, I'm not sure if we were able to answer your question. If you could try and make it a little bit more clear, otherwise, Mehdi's welcome to chat to you afterwards. And then I'm just scooting over to the Q&A section. Um, okay, a couple other questions here. Shamas is asking, is there a specific compliance for economic participation, even if the company is not yet incorporated, but only a regional headquarters incorporated?
If they are not carrying on any activities, uh, even if they are not carrying on any activities, unless they are classified as a dormant entity or inactive. If they are active, if their license is active, certain obligations will be applicable. They have to do certain submissions in that case.
Linda's asking what the difference between social insurance is, so GOSI versus end of service benefits.
GOSI is applicable like it's mainly for the local employees where contributions will be made by both parties, employee and the employer. End of service benefit is separate, where the employer need to maintain certain provision as end of service benefits for the employees.
So social insurance element is quite similar
Employee
to
will be
national
entitled to
pension
both.
schemes, right?
Employee will be entitled to both. Yeah.
Okay. Thomas is asking, we're a healthcare facility running clinics. Is the e-invoicing applicable?
Yes, I mean, as if they are tax registered business there, they need to issue invoices which are through invoicing.
Mhm. Ahmed's asking about carry forward losses. If I am merging two companies and both of them have losses in the past 4 years, do I get to utilize the losses for both companies, given that one of the companies will disappear?
It depends, like after merger, how is the shareholding structure? Um, uh, it depends on different
Yeah.
factors, and only then it can be assessed. Yeah.
Yeah, Ahmed, if you want to look at that a little bit more closely, that's obviously a very specific scenario. Maybe Mehdi can talk to you offline.
Yeah.
Just going back to the chat section. Okay, yeah. Lorna's saying that she'll reach out to us afterwards. And then what is the criteria for bad debt?
Bad debts for them, I mean, there are two different criterias. One is from accounting perspective, obviously as per IFRS, that is the applicable framework there. So you will be recognizing the provision or the bad debts as per relevant IFRS. You will be doing provision as per expected credit loss approach, and write off the bad debts when you think they are irrecoverable and then they meet the criteria defined in IFRS. From tax perspective, they should not, certain period needs to be lapsed, and it is almost certain that they will not be recovered. And then you need to get some certification for that from the auditors related to bad debts, and then you can claim them. Once you claim, if subsequently they are recovered, you need to take them into your income, and then they will be taxed.
And then there's a question about processing related party invoices. Does withholding tax apply to other countries, for example, South Africa, UAE, UK, and Philippines?
All cross-border payments, if you make any payment to a related party which is based outside KSA, they will be subject to withholding tax. The tax rate depends on the nature of transaction, and if there is double tax treaty with that recipient country, in that case it will change. And but for that you need to do proper documentation and get the approvals from the regulatory authority, and only then you can apply different rate.
Abdul's asking, can you please just remind us what's the difference between zakat versus tax?
Zakat is only applicable if a company based in KSA is owned by KSA nationals or GCC nationals. So it is the Islamic way of taxation. So it is only applicable if companies owned by the shareholders of the company are GCC national or KSA nationals. But if a company is owned by a foreign national or for an entity, in that case, the tax will be applicable. Zakat has a completely different way to calculate liability. Rates are different. It is mainly calculated on the net assets of the person or the company. A tax is based on profitability of the company, taxable profit, and it is 20%.
Okay, great. Vivek is just asking if SAP ERP has an option to use Arabic accounting, does that satisfy the requirement?
Yes, any ERP who is capable to produce the chart of accounts and the books and financial statements in Arabic. One aspect, other, it should be capable of producing invoices which meets the e-invoicing criteria. And the integration is possible with Zatka in phase 2 if it is required. In that case, yes, it is fine.
Vivek's asking if we pay zakat, do we need to pay tax as well, or is that a deductible expense?
Uh, Zakat and tax both will be applicable only in the case where company has mixed ownership. For instance, if a company is owned by a foreign national, let's say 30% shareholding is with foreign national and 70% shareholding is with KSA or GCC nationals. In that case, where the company has such a mixed ownership, in that case, both will be applicable. Otherwise, it will be one thing will be applicable. So if both are applicable, only the part of profit which is attributable to local shareholders, that will be subject to zakat, and the profit attributable to foreign nationals, that will be subject to tax. So the profit will be divided between the shareholders, and accordingly it will be taxed. So any zakat paid on the profit which is attributable to local shareholders, that is not deductible expense for the other shareholders.
Great. I think that summarizes all the questions we received. Mehdi's happy to also take any conversations offline and kind of help with advising a bit further. Thank you so much, Mehdi, for your time, and thank you everybody for joining us today.
Thank you so much. Thank you everyone for joining. Thank you.